All right, so with that, let me turn it over to Brian and Tom.
Thanks, Kevin. So Tom and I thought it'd be helpful for us to talk for a year-end tax update. It's a bit anticlimactic, knowing that legislation is at least dead temporarily. So what we've opted to do was I have a few slides on some federal incentives that a lot of our clients are taking advantage of and have taken advantage of, just walking through the mechanics of those. And then I also have a slide on what legislation looked like prior to being dead, and perhaps if it's revived, we'll at least have an opportunity to understand how it could impact individuals and businesses. And then I'll hand it off to Tom to walk through a very common conversation we're having with our clients, particularly over the last 12 months, and that's remote work and state and local tax implications as a result of those policies. Next slide. You can just go ahead too. There you go. So the first one, this is popular. Most of you on the call probably heard of it. The Employee Retention Tax Credit, ERTC. It's a tax incentive that effectively subsidizes, provides a credit for wages paid to employees either during 2020 or during 2021. Some questions to be mindful of, at least for 2020, if the business had suffered a 50% decline in receipts in any particular quarter 1, 2, 3, or 4 compared to that of 19. If there was a full or partial shutdown of your business or a segment of your business, we're seeing a lot of our clients qualify under the partial shutdown rules. Depending on your business and your industry, that can be sort of a very gray area as far as how the shutdown rules would apply, but we are evaluating that for all of our clients that don't necessarily satisfy the receipts test. And then turn our attention to 2021, where the shutdown rules are a bit less present, but the receipts tests are still available. For 21, the receipts decline test compared to 2019 business activity is a 20% reduction. So versus the 2020 ERC of 50, 2021 has a reduction of 20%. So for example, if you compare your first quarter of 21 revenue to your first quarter of 2019 revenue, and there's a 20% reduction in 21 versus 19, then that will be an eligible quarter for ERTC in 2021. Next slide, Amy. This is just reciting what I had just said, just making it as bold as possible so we understand what we're focused on. The 50% reduction in 20 was a pretty large hurdle for some of our clients, although we do have some clients in the hospitality industry and the event industry. So we did see it, but where we're seeing a significant opportunity again is in the 2021 year, wherein that reduction is 20%. And you might be saying, well, how is the credit calculated? For 2020, there's a credit of up to $5,000 per employee for the entire year of 2020, depending on the eligible quarters. For 2021, that credit is expanded to apply for the first quarter, the second quarter, and the third quarter. And each quarter stands independent of itself, meaning that each employee can be used to calculate a 70% credit up to $10,000 of an employee's wages, or $7,000 per quarter per employee, meaning that one employee can generate the business with $21,000 in tax credits, since there are 3 eligible quarters in 2021. I have the employees here, and the reason for that is for 2020, the credit's a bit less lucrative if the overall headcount for a business, as calculated on the 2019 year, is 100 employees or more. The credit becomes a bit more difficult to calculate in that regard. The 21 credit does expand that headcount up to 500, which does provide a bit more of opportunity for businesses to take advantage of the ERTC program. The other component I have here is that the election to use a particular quarter, you can use either the current quarter, or you can look back to the previous quarter to see if a particular quarter is eligible for ERTC. So what does that mean? There's a lot of calculations and percentages and head count. This last bullet is probably the most confusing, at least in my conversations. But for 2021 ERTC calculations, if you want to see if you satisfy the revenue test for a particular quarter, that being the 20% reduction in revenue, you can either look at the current quarter you're in for the first quarter, second quarter, or third quarter of 21, or you can look back a quarter, meaning that if you're evaluating first quarter of 21, you can either look at the first quarter of 21 and compare that to 19, or you can look at the fourth quarter of 20 and compare that with 19. And we have seen a lot of businesses be eligible for ERTC as a result of the look back test for the prior quarters versus using the current quarter. Next slide. Some considerations, and this is where the planning and being cognizant of the impact of ERTC comes into play. Prior to legislation at the end of 2020, which is about a year ago tomorrow, I think, I'm going to celebrate tomorrow, there's an ability to take advantage of ERTC even if you have received a PPP loan. So prior to that, the CARES Act effectively eliminated opportunity for ERTC if that business participated in the PPP program. The bipartisan bill at the end of 2020 eliminated that issue and now allowed all businesses to participate in both programs. One thing to be mindful of, especially as you're heading into the 2021 tax year, if you're a particular business that does take advantage of the R&D tax credit, there's some additional legwork there to ensure that we're not double dipping on credits, meaning that you can't use ERTC wages to calculate your R&D tax credit. So there has to be some carve out there. So the clients where I do have ERTC and R&D, I'm being cognizant to make sure that I'm not just relying on sort of a same as last year approach when I'm calculating estimates and so forth and taking into consideration the credit. So that should be at least evaluated, especially when you're working on the R&D credit study for the 21 year. Paid sick leave credits, Families First Act. Those credits, those wages utilized to take advantage of that program can't also be used to take advantage of ERTC. And when you are evaluating wages that are eligible, don't forget that health insurance benefits as a result of the company subsidizing some of the health programs for employees. The overall wages for a particular employee not only includes their compensation, but also the health fringe benefit that they're entitled to that the company pays on their behalf. And the last but not the most favorite, ERTC, unlike the PPP, is included in taxable income for federal purposes and also for state tax purposes. So when these amounts are applied for and the claim is inserted and you're booking this on your balance sheet, just be mindful that for financial statement reporting purposes, this will be an income, and this will also be an income for tax purposes. Next slide. My other favorite credit, and this has been around for a long time, but I'm seeing more and more of my clients appreciate its opportunity. This is the Work Opportunity Tax Credit, WOTC for acronym's sake. That does allow for an individual, a employer to take advantage of a federal tax credit for employees who begin work today or through the end of 2025. So this program was extended again under the same act at the end of 2020, the bipartisan bill, and it provides an opportunity for businesses who are seeking to hire a sector of employee. We'll go over some targeted groups with a subsidy for the wages that are paid for a particular employee over a 2-year period. Next slide. So in order for a prospective employee, if they are hired, in order for the employer to take advantage of this credit, an employee has to affirm that they are a member of what the IRS refers to as a targeted group. So a targeted group can be one of these various things. Where we see a lot of opportunity is in the veteran arena or in the long-term unemployed. So if you have an individual who has been unemployed for a particular amount of time, the current term is more than 26 weeks. There could be a tax subsidy in the form of a credit available to the employer who employs this individual. Next slide. Now, in order to obtain the credit, the individual has to work at least 120 hours, but a maximum of 400 to obtain the maximum credit. So this credit is it's sort of hard to appreciate the complication in all this. If we go to the next slide, I want to walk through the process. I think that the process is the most important aspect of taking advantage of this credit. So in order to actually have an opportunity to take advantage of this credit, this IRS form 8850 has to be included in the application process for any new hire. So a prospective employee will complete the employment application, and they will also complete this IRS form. To the extent that an individual is hired who had completed that form and they had checked one of those targeted group buckets, those boxes, that form is then submitted within 28 days of hire to, if it's Pennsylvania, the State Department of Labor. The State Department of Labor is responsible for certifying that the employee completed the form accurately. If they were unemployed, the state would know that. If they were a veteran, the state would know that. They have the authority to reject or accept those forms. And to the extent that they accept it, it comes back to the employer. That allows that employee's compensation to now be included in a bucket for this credit. And then the credit is actually reported on the corporate tax return. So if you're a C Corp, there's a direct reduction in your corporate tax liability on the 1120. If you're a pass-through business, whether it's a partnership or an S Corp, the credit is reported on the S Corp, and it reduces the owner's tax liability on their personal return. But just one main point here, timing is everything. So process is everything. If you do intend to hire over the next 3+ years, this is something that is alive until that time. One key thing is this credit, to the extent that it hasn't been taken advantage of. There's no retroactivity to this program. It would have to be prospective if you were previously unaware of the program, meaning that if you did have new hires in the last 9-12 months, those individuals would be ineligible for this credit. This program would have to be taken advantage of on a prospective basis. So again, the process is everything. The form's completed when they're applying, the form's submitted once they're hired, it comes back from the state. Then we start to track the wages over that period of time. And again, the tracking is over a 2-year period with a minimum of 120 hours to get at least a percentage of the wages back in the form of a credit. And the reporting is done on the corporate tax return. So if, to the extent that you take advantage of the credit, it could be subject to an examination if the corporate return was examined by the IRS. But other than that, there would be no other federal or state institution that would be auditing the utilization of this program. I think the next step is legislation. This was a lot of fun. I've been using the analogy of a roller coaster, say the King to Call, if you're familiar with that, in Six Flags in Jersey. It seems though the president and Congress, at least on the Democratic side, really started off really fast and went really high. We're going to get all these great things, and we're going to add surtaxes, and it's going to be so easy to get through. And then if you're familiar with King to Call, it comes down as almost as fast as it went up, and then it just stops. That's really what happened. So what was in the bill? This is only somewhat of a component of the bill. The bill was pretty expansive, especially in April. But what would be impactful to a lot of businesses is that income tax rates were actually going to stay the same. That's in the House bill as well as the Senate bill that they agreed on. What was going to change was that there were going to be a variety of surtaxes on business owners and individuals with net worth over a certain amount. So those surtaxes could have been as high as 12%. So that was a pretty big concern for a lot of our business clients, particularly those who have trusts as owners. So that was something that we were already start to plan ahead for, but at this point it is dead, so we weren't particularly concerned. Most of you may or may not be familiar with this, but there are child tax credits that were increased during the year. Most of our, depending on perhaps even yourself, you could be taking advantage of getting a advance credit. There was going to be an extension of that program going into 2022. There was a large impact on retirement planning and certain required distributions that would start for certain high net worth individuals. And one of the other items was a large expansion of what's eligible for investment tax credit, mainly on the solar side. So the Build Back Better plan was very intense on creating renewable energy projects and giving opportunities for businesses to think a little differently as far as what energy they could use. So there was some large incentives on the corporate tax side in the form of getting tax credits for certain investments in renewable or solar energy. Next slide. It's my last one. So this is, I'm breathing a sigh of relief, to be completely honest. Traditional tax planning survives. What I mean by that, that means that if rates were going to go up by 12, 15, 20% in 2022, most business owners would be prudent to say, hey, I'd rather pay tax today at a much more friendly environment than 2022. So I was referring to it as twilight zone planning, where most, you wouldn't rather pay tax today versus tomorrow, but in that environment you would. So traditional planning survives. Deductions in this year, deferral of income, still status quo to the extent that it's available to a particular business. And just one thing that I want the businesses on the call that are operating under a pass-through environment, just be cognizant of state entity level tax payments. So these are tax payments that are otherwise made as shareholder or partner distributions for taxes due in a particular state, whether you do business in Jersey or New York or Maryland and so forth. You could owe taxes in the states as a result of you doing business there. Currently, those tax payments without these elections would be non-deductible to the business owner because of what's known as the SALT cap. So a number of states in the surrounding area and even nationwide have installed these entity level tax payments, which the IRS has blessed. They put out a notice back in November of 2020, which does allow for these payments to be deductible. So you're effectively creating the ability to deduct what would otherwise be non-deductible state tax payments to deductible. So there's a pretty significant rate of return on these tax planning opportunities. Just be mindful of really two things: the timing of the elections in a particular state, as well as the classification of these payments for the tax return, as well as for your financial statements, to the extent that you have financial statements. So if you have any questions on all those, we will be checking our chat and Q&A at the end, and we can go over any follow-up questions on any of these items. But as of now, I'm going to turn it over to Tom.
Good morning, everyone. As Brian said earlier, the topic that we are having conversations with our clients about on a pretty regular basis right now is the temporary work from home arrangements that most employers put in place, and the migration to a permanent work from home scenario. And we thought that it would be helpful for us to at least kind of share with you the conversations and the content that we've been having with our clients. So, for example, as I said, the world responded to the pandemic by migrating positions from the in-office to work from home. And many states responded to those work conditions as well. And what they did was they suspended a lot of the rules around the work from home issues that it creates for businesses and employers. And what that was intended to do was be very, very temporary in nature. Now, the pandemic lasted for a much longer period of time than businesses, employers, and states ever expected. So those temporary solutions for employers remained in place for an extended period of time. What we've seen is that that temporary relief has expired or will expire by the end of this year. And the provisions, the temporary relief that hasn't expired, the states that still have them in place are very, very few. So for the most part now, with businesses having remote workers on a permanent basis, it really means that companies need to start evaluating what the repercussions are of those remote working arrangements. And they have to be measured against what the rule sets are that states had in place pre-pandemic, because that's what states are reverting back to. And that's what employers are going to be held accountable to. And you'll hear me say employers and businesses, and many of you out there might be saying, well, wait, what's the difference? To me, the difference really is with regard to the exposures that companies encounter as a result. You're going to have issues arising on the payroll tax side, and you're going to have issues arising on the corporate level side, and or for pass-through entities, the shareholder owner side. And that's what really needs to be evaluated and what businesses really need to be considering at this point. Next slide, Amy, please. So what you want to begin considering are new filing requirements that the entity may have, not only for corporate level or entity level taxes, shareholder owner level taxes, but also for employment taxes. Businesses have to question whether there are new withholding requirements expected of them. And this gets into the fact that, for businesses that are in Pennsylvania, Pennsylvania utilizes the convenience of the employer rule. And that really is in direct contrast to a state like New Jersey that looks to see where the service is performed by the employee. So, you've got these tensions that are created between varying rules established by the states for withholding purposes. Pennsylvania always maintained, even throughout the pandemic, that convenience of the employer rule still was the rule, and they didn't care where your workers were working on a temporary basis. If they were assigned to a PA location, those were still PA wages. In direct contrast to that, we had Philadelphia that said, look, we use convenience of the employer rule for Philadelphia city wage tax. We're going to suspend that rule. And so any non-residents that are being required to work from home aren't subject to the city wage tax. And that rule has ended. So now you're back to the convenience of the employer rule that is being imposed by the city of Philadelphia. And so employers need to respond to those types of withholding requirements. We have clients that shifted during the pandemic and stopped withholding for their non-residents. We had other clients that said, we're going to maintain withholding as usual. And a lot of them were forced to do that because they didn't have the systems to begin remitting the local wage tax, earned income tax in the various Pennsylvania localities where their employees were located and working from home. And what we're seeing now as a result of the remote work arrangements that are going from temporary to permanent is a shifting at the entity level of tax costs. And a lot of those shifts are occurring because of apportionment. So all of a sudden you now may have payroll that's being apportioned to the state that wasn't previously. You may have property that's being apportioned to that state. And in states that use a market-based sourcing rule that approximates a cost of performance methodology, you could have sales that are now being apportioned to that state. So it's just, uh, the message is to just be aware. And what we're also seeing is this elevated risk management that businesses are having to perform as a result of these remote work arrangements and expanded tracking requirements, really understanding where your employees are working. We had a client and they had an employee that was changing their work location every 3 months because they thought, oh, this is the greatest time for me. I can go and explore all the different places that I thought I might like to live. And they kept notifying the employer of these residency shifts. And the employer initially was trying to comply and made adjustments to their withholding until they finally said, stop, we're not doing this anymore. And you need to consult a tax attorney or a tax accountant to understand what your responsibilities are. And that business was in Pennsylvania, and they went back to withholding Pennsylvania taxes. And what we've had, or the conversations we've had with our clients, are that, you know, you have operational considerations and then you have tax considerations, and those considerations need to be deliberate in terms of what or how the business is going to respond. And we as a firm with our clients have been advising them in terms of, you know, what does the business want to do? Does the business need to, from an operational perspective, have these remote work arrangements? And if you need to have them, is it across the board, or is it more discriminate in terms of who can and cannot work from a remote location? And then marry that against the tax considerations, recognizing that you may have expanded state tax filings or even local tax filings, right? You may have expanded or increased exposure in certain situations because of those remote work arrangements. And that's what we really mean by the consideration employers and businesses are giving to remote work arrangements have to be deliberate. Next slide, thank you. So remote work scenarios, they're not new. They've been around for a long time, and many states had adopted rules around remote workers, usually referred to as telecommuting, right? And a lot of those situations were on an as needed basis. Well, what did change was what we refer to as the COVID effect. And the COVID effect made remote work so much more available. And it is now what we are seeing becoming more permanent, with many of our clients saying that a lot of their workers will remain remote. They won't return to the office. And so what we see are situations where the states are responding to that. The states are now in the position of taking a step back, taking a breath, and really beginning to understand what it is that they have and how the landscape has changed. One state where we see that probably the most significant administrative enforcement of employer withholding is around New York State. And New York State and New York City have been very aggressive. And what they are doing is, New York City income tax is only due from residents, but what we are seeing is that there's a very, very heavy audit initiative around anyone who is claiming that they left the city and moved during COVID. And so, you know, these are things that are going to emerge as we move forward in 2022 and beyond that.
Hey, Tom, I
Yeah.
apologize to do this, but I'm gonna have to stop you here because we have to, it's been very informative. We have to leave a little bit of time for Amy, but I did want to have, thank you very much. I did want
Yep, no
Brian
problem.
to answer two of the questions that popped in, if you can see them there, Brian.
Yeah, so question about exempt organizations. So the ERTC is actually treated as a reduction in your wage expense. So that would just increase or decrease rather your expenses, and depending on how you're calculating your 990 and its applicable tax, that's how that reporting would impact the tax return. It would be a direct reduction of your wage expense. And then someone had mentioned the ability of a third party to manage the process for the WOTC. That's actually very common. Depending on the volume of new hires you're looking to take on, it is recommended to have a third party, whether they're affiliated with your payroll vendor, to manage that process. It does take a lot of the stress out of the process.